Good afternoon. Welcome to the Trends in the M&A Market webinar. My name is Robin Taylor. I'm the Manager of Member Services here at Chief Executive Boards. Our CEO, next slide. Our CEO, Kevin Minton, was scheduled to host the event today. Unfortunately, he ran into some unexpected travel delays and he is unable to join us. So I will be filling in for him. In the event that you have a question, we will be answering those at the end of the webinar, but you can go ahead and post those in the panel box on the side. There's a question box, and you just post that, and we will address those at the end. And we will be covering as many questions as possible at the end of this presentation. So let's begin. Next slide. Before we dive straight into our main topic, let me briefly tell you about Chief Executive Boards. We are a boutique executive peer advisory service headquartered in Greenville, South Carolina. We offer boards in multiple cities throughout the United States and national boards at our summits. You can learn more about our organization at www.chiefexecutiveboards.com. Next slide, please. So what's our purpose? We help CEOs, presidents, and business owners share ideas and experiences so they can avoid the pitfalls that others in the same shoes may have experienced. We basically keep our members from reinventing the wheel. Essentially, it's where highly successful chief executives go to become more successful. Next slide. Members convene in face-to-face forums. They receive advice in safe and confidential environments. This is typically information and feedback that they're unable to get anywhere else. To simply put, it's like having their own personal think tank. Next slide. And as an example, some of the questions, or one of the questions we often address, is what keeps our members up at night. These are the issues that they don't have the opportunity to discuss with anyone else. Our members benefit from local and national advisory board forums, and they attend educational summits, as well as having access to CEBI members across the country. So briefly, we're going to go over just a few housekeeping items. The webinar will last approximately 45 minutes. As a reminder, post your questions in the panel box, and they will be addressed at the end of the webinar. The webinar is being recorded. That is often a question we get. It is being recorded and will be available on Friday, if not sooner. Okay, let's get started. Next slide. Let me introduce you to John McDonald, our wonderful guest presenter today. John is the Senior Managing Director as well as the co-founder of Hyde Park Capital Advisors. In a nutshell, John originates, executes, and manages private equity and debt placements, as well as a multitude of other services, which I'm sure he will touch on in just a moment. John, welcome.
Well, thank you, Robin. I hope everyone can hear me. I'll try and speak as clearly as possible. I do a lot of public speaking, but I will confess this is my first webinar, so I'm actually pretty excited about it. So again, it's a pleasure to have the opportunity to speak about my favorite subject, which is mergers and acquisitions and trends and outlook. A little bit about me real briefly. My first career was engineering. I was a mechanical engineer out of Duke University, and I had the privilege of working on some very cool projects with IBM in launching their first personal computers back in the early 80s, and also worked with Motorola in launching the first consumer cell phone back in the early 80s. Then I was up for a new challenge. I went to business school. A friend recruited me to the Wharton MBA program, and that is where I was introduced to the world of investment banking. And from there, I joined Raymond James and was part of the team that basically started the investment banking group, and I worked within the healthcare practice. And after a dozen years of executing lots of public offerings and private offerings and mergers and acquisitions, I teamed up with another senior managing director in the investment banking group by the name of John Hill, and in January of 2000 we decided to leave the mothership start our own boutique investment banking firm. And so for the past 16 years here at Hyde Park, we've been focused on, as Robin said, private placements, M&A, fairness opinions. More recently, the bulk of our work has been selling private companies, although occasionally we'll sell public companies. That is really our forte. We focus primarily on serving companies throughout the Southeast, but over the last few years we've been working with companies all over the United States. Our buyers come from anywhere in the world, so that's how we spend our time. We're a team of about a dozen people based in Tampa, Atlanta, and Greenville, South Carolina. And so based on what we do, we were asked to give this webinar for those of you interested in the M&A markets. Today we will discuss current trends in the M&A market. We'll discuss the role of private equity in the M&A market, and then give you our overall outlook as to what we see going forward, and then finally talk a little bit about the M&A transaction process. So in order to understand kind of trends in M&A, there are really two statistics that kind of size up the M&A market. The first statistic is volume, meaning number of transactions, and then the second one is value, the dollar amount of transactions. And I'm going to focus primarily on the U.S. market, since my guess is most of the audience here on this webinar will be U.S.-based firms. And the global market follows the same trends, just a multiple of these numbers. But so if you look back 10 years, you'll see that 2007 was really a banner year. It was an absolutely fantastic year in terms of volume and value, as you'll see in the next slide. And then, of course, we had the great recession hit in 2008, and volumes declined significantly in 2008, and then the market really bottomed out in 2009. But since 2009, even though the recovery has been slow, in fact the slowest recovery since World War II, there's been a very nice increase in the volume of transactions, and you can see that we're close to the all-time highs again in 2014 and 15. But as you break down the first half of 16 versus the first half of 15, you can see that the volume of transactions is down. We attribute some of that to, again, kind of the slow nature of the economic recovery in the United States, but also we're in this kind of crazy political world where there's a lot of uncertainty surrounding the elections coming up, and uncertainty causes some people to take pause, and we think that's what's driving some of the decline as well. What's notable though about volume is that we break down the total volume into 4 different segments: transactions less than 100 million, 100 to 500, 500 to a billion, and then greater than a billion. And what's interesting to see is that the bulk of the market has always been kind of transactions less than 500 million, which is what we define as the middle market. So in any given year, somewhere around 85%, maybe as high as 90% of actual volume are middle market transactions. And that's really not well known, because people read about the very large multi-billion transactions, because those are the transactions that get all of the media attention. So most people think that really the action is on the greater than billion, but in terms of dollar amount, as you'll see in the next slide, that is very true. But in terms of actual volume of transactions, the middle market is really where all the action is, and that's where our firm, that's where we spend our time. And then the next slide, it's the same look back 10 years, but this time we're looking at value, not volume. And you can see what I was talking about in terms of value. That it's the big transactions, even though they represent well less than 10% of volume, they represent the lion's share of the actual dollar amount. And going back, again, 2007 has always, for the last kind of 10 years, has been the benchmark year that we've since it was the record year. You can see that in the U.S., volume of transactions actually last year exceeded 2007. And then now if you take a look at first half of 15 versus first half of 16, again, since although volume was down over 30%, you can see that total value is up over 20%. And that again is attributed to a lot of very large, multi-billion-dollar M&A transactions taking place. So, we think that as we approach the end of the year, volume of transactions will be down, but it could be that 2016 turns out to be, the best year in M&A value-wise, again attributed to these very large transactions that you've been reading about. The next thing I'd like to talk about is the role of private equity in the M&A market. I've been now an investment banker involved with M&A transactions for almost 30 years. And I will tell you, when I first started my career, we didn't even hardly know what private equity was. I mean, leveraged buyouts were kind of just getting started. I mean, they really got started in the 70s and 80s, but the category of private equity was really, as an investment category, was really not well known and well accepted. So there wasn't a lot of monies flowing into, I should say, private equity. But over the last 20 years, what's happened is that the private equity segment has really become a growing part of the asset allocation pie. If you take a look at endowments, like school endowments, in fact, there's an article on endowments in today's Wall Street Journal talking about how Harvard, for example, is hiring a new wealth advisor because their performance is not as good as it should be. But if you were to just take a look at large premier university endowments, you will see that some of these endowments now have allocated up to 50% or more than 50% of their endowment dollars to private equity. So what's really happened over the last kind of more like 10 years, but broadly 15 to 20, is that the amount of money flowing into private equity has been in the hundreds of billions of dollars. And so now, instead of corporate America or corporations in general around the world being the primary buyer of companies, private equity has really become a major player. So when we sell companies, as long as the company is a candidate for private equity, we ask for a broad mandate to take those companies to those two big now buyer segments, the corporate buyers and the private equity. And one of the things that is really driving this really hot M&A market is the amount of private equity capital that is looking for transactions. Keep in mind, when a private equity fund raises capital, they get commitments from their limited partners, and then they draw down, they make capital calls from in order to take down transactions that they purchase. But there's a fuse on that money, so they only have a certain amount of time to put all of those committed amounts of capital to work, and the last thing they want to do is give it back. In fact, it's almost unheard of for private equity firms to actually give back money. So when they raise the money, they get the commitments, then it's all out to try and put that money to work, and so they're very, very competitive in the marketplace looking for transactions. And at the end of 2015, you can see from the chart, there was over $1.2 trillion of private equity dry powder, basically money that's been committed seeking investment or buyout opportunities. So all of that money is out there looking for transactions. And then if you take a look at the traditional buyer of companies, which is corporations, we show that corporations just in the United States, excluding financial institutions, have close to $2 trillion of cash sitting on their balance sheets, and in today's low interest rate environment, they're really not earning anything on that capital. So if you're a corporation Now, let's say you're a large corporation and your revenues are very closely tied to GDP growth. Well, that means that your own revenues are probably growing pretty slowly. And if you've got shareholders that are clamoring for double-digit top line and bottom line growth, and the best you can do is, low single digits because we're in a slow growth economy, what are you going to do? If you got, $2 trillion sitting on your books and cash as a percentage of assets is an all-time high, somewhere between 7 and 8%, earning nothing, well, you're going to use that cash to go out and buy other companies. So you've got a lot of demand from corporate America looking to buy companies to, supplement their very slow organic growth. So private equity combined with corporate America and all this cash sitting on the sidelines is really one of the main drivers of all of this M&A activity that we're seeing today. On the supply side, I don't have a slide for this, but on the supply side of deals, you've got a lot of, there's a demographic trend, which is basically you've got aging baby boomers that are at the point in their lives where they've built nice companies, they've now recovered from the Great Recession of 2008, 2009, and they're seeing valuations at very healthy levels. As the stock market bumps up against all-time highs, well, the public market is kind of like a tide. As the tide rises, it rises all boats, which means it pulls up the valuations of private companies as well. And so you've got a lot of aging baby boomers that have recovered fully from the Great Recession. They see attractive pricing, and part of that attractive pricing is because there's so much cash looking to be deployed and buy companies. So you basically have what I call a perfect storm for M&A deal making. Low interest rates, lots of cheap credit available, lots of corporate cash, lots of private equity cash, lots of aging baby boomers. And then there's other waves also taking place. For example, another big wave that we're riding is consolidation within healthcare. And with or without ACA, healthcare is 18% of our economy. It's a huge, highly fragmented industry, and there's still way too much cost within the healthcare sector. So what is one of the best ways to eke out, cost savings? Best way is actually putting companies together, consolidating, eliminating duplication, eliminating, a lot of redundant costs. So there's a tremendous amount of consolidation taking place in the healthcare. There's lots of other trends like that and waves that we're riding. I don't have time to talk about all of them, but those are just a few. I want to talk a little bit about the two different type of buying groups. Again, we talked about corporate buyers, which is what most people think of traditionally because they've been the buyers, for going all the way back in history, where the private equity buyer group is a little bit newer and not as well understood. But they are very different. Corporate buyers, again, they acquire companies in order to complement or supplement their own internal organic growth. And when economic growth slows, corporate buyers tend to want to buy more companies, again, to achieve those double-digit top line and bottom line growth numbers to satisfy their shareholders. They look, they're strategic buyers, so they look for not only top line, bottom line growth opportunities, but if they see companies that have ideas or methodologies or products or customers that supplement their own, those are all strategic reasons to make those acquisitions. They may be looking to expand market share. They may be looking to eliminate competition. They may be looking to increase their customer base or diversify their customer base. There's a lot of companies that are, it's their business plan to consolidate a segment. They don't like to use the word roll-up, but there's a lot of roll-up companies out there They call themselves consolidators because they see that if they put a lot of, particularly in highly fragmented markets, if they can put a lot of little pieces together, the sum of the whole is worth a whole lot more than the sum of the pieces. So there's a lot of that going on. They want to leverage relationships and distribution and sales channels. They want to buy companies on an accretive basis, meaning that they want to pay a pricing such that immediately upon or soon after closing, they get a bump in earnings. Obviously, if they're public and they can make lots of accretive acquisitions, that's going to be good for their stock price because their EPS goes up. They can typically pay a higher price than private equity firms because they can achieve synergies, cost savings, where private equity in many cases can't unless they already have a platform company. The deals are not as dependent on leverage, where private equity typically uses a lot of leverage or what they call financial engineering to make their purchases. So those are some of the reasons corporate buyers are out there buying. Private equity, again, a very different animal. In which there's well over 1,000 private equity firms now just in the United States. They're in it for the financial return. So they have an investment horizon. It's usually 3 to 7 years, kind of like the average, let's call it 5 years. And within that 5-year period of time, they're going to work very closely with the management teams of the companies that they buy to maximize their internal rate of return, or in some cases cash-on-cash return over their investment horizon. That's the sole reason they're making these investments. The private equity firms, their money comes from limited partners. Limited partners are investors. Investors are in it for the return, and that's just how it works. They make two different kind of acquisitions. They like to buy large standalone platforms, and they then, in many cases, well, they will tell you that they bet on the jockey before they bet on the horse. So they're looking for great management teams, platform acquisitions, and then they use the platforms and the management teams that they're betting on to then make additional add-on acquisitions. So they typically pursue a double path strategy. Path number one is do everything they can to maximize internal organic growth, but then also they have an add-on strategy, and the management team that they're betting on is going to be challenged to buy as many tuck-in acquisitions possible to then grow through acquisitions as well. So they do a lot of consolidation. Private equity is more price sensitive because again it's all about the math to them. They typically lever their transaction. Again, through financial engineering or leverage, they can get increase or greatly maximize their internal rates of return because of the debt, and they typically use senior and sub. In today's market, for the smaller transactions, they're looking for maybe 3 times EBITDA in terms of senior debt, and then maybe another extra 1 times in sub debt. But if the larger transactions can command more, and I've seen some of the larger transactions where all in the debt can be as high as 5 or 6 times kind of current run rate EBITDA. So that's an important part. Some sellers or management teams don't feel comfortable with all that debt. Some do, but the management teams that are comfortable, they benefit from the debt because they're typically rolling over a significant amount of equity themselves as they stay in and manage the company. So if the transaction works out with all of the debt on the books, they then will obtain a significant return on their rollover equity. Private equity tends to move faster and quicker than corporate buyers just because they're more nimble and because they know that sometimes, since they're more price sensitive and may not necessarily be able to compete on price, they can compete on speed. So they tend to win transactions from corporate buyers, to the extent that the sellers are, very sensitive to speed to close and not necessarily just focused solely on purchase price. So those are the differences between the two main buyer groups. So what's our outlook? Well, to be in this business in general, you have to be somewhat optimistic. And I've been accused of being a very optimistic person, and that's just my nature. But I have a lot of reason, particularly right now, to be optimistic. This market, even though it's been, recovering very well since the low point in 2009, it's been a good market. And when you take a look at, even though volume is off, kind of the first half of this year versus first half of last year, volume or pitch activity is actually at a record high. When I say pitch activity, what I mean is that that's the leading indicator for us as to what the near-term M&A market's going to look like. And what we've seen is, although we've had a steady Eddie year and a steady Eddie summer, what we've seen is a huge pickup in pitch activity since Labor Day. That's not unusual because a lot of business owners, they're through with their vacations, their kids are back in school, they're back at work, and now they're focused on what are they going to do. And so there's always a kind of a seasonal pickup in M&A activity after Labor Day. But this year's a little bit different, and I think a lot of it has to do with the fact that we are in an election year, and this is a very unusual election year given our presidential candidates. And so there seems to be, from what I'm hearing, I'm reading, just a lot more uncertainty right now in an election year than we have had in the past. And the uncertainty is causing a lot of, again, aging baby boomers to, reconsider, do they want to kind of continue to stay independent for the long term, or, are they interested in now at least exploring the market to determine whether or not they want to take some chips off the table, or, maybe all the chips off the table. So our phone's been ringing off the hook. We've been making a tremendous amount of presentations to corporate boards and corporate owners, really educating them on this overall state of the market. And so we're now in the process of converting a lot of these presentations into actual engagements. So for the near term, I don't have a crystal ball, no one does, but I would tell you for at least the next 6 to 9 months, I think you're going to see a tremendous amount of M&A activity. Beyond that, who knows? I can't sit here and tell you that I know what's going on. I will tell you that all these portfolio companies that private equity has been buying up, a lot of them are going to be hitting that 5 to 6 year horizon. All of those transactions are probably going to come to market. There's no shortage of aging baby boomers, so those deals are still going to have to come to market. You've still got a tremendous amount of consolidation in healthcare and in other areas such as financial services. Those deals are going to come to market. So I think as long as there continues to be a tremendous amount of supply of transactions, and as long as there remains a tremendous amount of dry powder within private equity and on the books of corporate America, and as long as the lenders, banks, and non-banks continue to lend, I think that this perfect storm, could for M&A transactions could continue for some time to come. So with that, let me just transition a little bit to the process. What does investment bankers do? Well, we're the quarterback for the process. Business owners, boards, your time is best spent running your company, advising your company, not necessarily trying to run an M&A process. If you think you can do it yourself, well then, good luck. Most firms that do it themselves, typically what they do is they get approached, and any good company in a good market will receive unsolicited interest. But if you try and go down the path of getting a transaction done with just a one-off unsolicited indication of interest, and you're not creating a competitive bidding process, most likely you're not going to get the best outcome. And if all you're looking for is a fair outcome, but not necessarily the best outcome, that's probably not a bad route to go. But most of the business owners that I know, particularly if you're a public company, you really have a fiduciary obligation to your shareholders by law. Really the best way to maximize price and terms is to run a process, run a competitive process so that all of the potential buyers know that they have to put their best foot forward, and therefore when you run a process like that, the best offer is going to rise to the top. And then you know as a business owner that if you do choose to consummate a transaction with a particular buyer, that you can sleep well at night after you close that transaction knowing that you didn't miss anything. There weren't better other buyers out there that you just didn't see. So we run that whole process from soup to nuts. We put all of the first month, we're in the preparation stage. We put all of the what we call go-to-market materials together. So we kick off the process with an org meeting. We create a virtual data room. We set it up. We start populating it with all the information that buyers are going to want to see. We prepare the marketing materials. The main marketing material is called the CIM, C-I-M. It stands for Confidential Information Memorandum. Then there's other documents like a management presentation, a one-page overview, which we call a teaser, a non-disclosure agreement, and then of course we create the buyer list or the investor list. So the process we run is a very targeted process. It's not a mass market process. And to make it to the buyer list, there has to be some very compelling reason to make it to the list. This is a confidential process. There's nothing public about it. So we confidentially contact the buyers. We make them sign non-disclosure agreements. So it's a very discreet process. After that first month, we get into month 2. Then that's the marketing phase. We contact the buyers that our clients have already reviewed and approved. And then we call them. We give them an elevator pitch. We then, if they're interested, we send them the one-page teaser. Again, no name of the company. We have them sign a non-disclosure agreement, and it's only then when we countersign will they know the name of the selling company. We then deliver the information materials, again, the main one being the confidential information memorandum. We'll typically host conference calls with management for the buyers that are kind of most promising. And then at some point in our process, when we know we have a critical mass of interest and there's no more questions to answer, we then draw a line in the sand and say, ask for bids. And we're very clear on what we want in the bids, and all the bids have to come in at the exact same time. So we're not in this very difficult situation where we're trying to evaluate birds in the hand versus birds in the bush. So the bids come in typically around the end of month 3. And at that point, if the bids look interesting, we evaluate, we compare, we contrast. We then shorten the list of bidders to a handful that we think look interesting. We then invite them for management meetings to kick the tires. We meet with them because, again, not price and terms are important, but so are chemistry, rapport, shared vision. All of those things are very important components, which are all subjective, and you can't really understand those subjective qualitative aspects unless you have these meetings. We typically follow the meetings by dinner, so we break bread, we get to know them more in a relaxed social setting, and then we ask for best and final bids, and when they come in and we push these bidders to their full potential, then if there's one bidder in particular that we want to move forward with, so price, terms, and all these qualitative matters, we then work with them, negotiate with them. This is typically where the attorneys first get started. We start then converting that bid into a very detailed non-binding letter of intent, which we then sign. The only aspects of the letter of intent that are binding are reaffirmation of the confidentiality of the talks, and the seller will grant the bidders some period of exclusivity. They typically ask for 90 to 100 days. We'll ask for 30 to 45 days, and on average we end up around 60 days of exclusivity. And that's important because it provides the bidder with protected period of time for them to spend a lot of time and money doing due diligence and hiring attorneys to work with your attorneys to get all of the legal documentation done. And then we're in the final phase of due diligence. They have full access to the virtual data room and access to all of your information. The attorneys are then working with each other on both sides to negotiate the final definitive purchase agreement. Once that document is, and all the ancillary documents are completed and due diligence is completed, then a close date is set, the transaction closes, and monies are wired. So that's a little bit about the overall trends of the M&A market. We talked about a little bit about the different type of buyer groups between corporate and private equity and their roles and how they're different. We've talked about my personal outlook based on what I'm seeing and reading. We've talked a little about the role of the investment banker and why it's important to run a competitive bidding process if you want to maximize price and terms and find the absolute best buyer. And then we talked about, the process itself. So with that, I think I'm running out of time. I'd like to open it up for questions.
Thank you so much, John. Yes, we do have a few questions, and the first one comes from Brian, and he asks, from your experience with clients, do you see more interest from private equity buyers or corporate buyers?
Yeah, no, that's a really good question. I would say that not all transactions are for corporate, and not all are for private equity. So it starts with the objectives of the selling company. Since corporations typically like to buy 100% of a company, owners who want to retain a meaningful share going forward and stay on with the companies probably are not going to want to go in that direction. But for those buyers that are open to both, in this current market, there will be considerable interest from both corporate buyers and from private equity buyers. But the deals will look very differently in that corporates are going to want 100% typically. The private equity is going to be anywhere from 51 to 80%. If you look at the sheer numbers, I haven't seen the stat lately, but typically private equity would represent maybe, let's call it, a third to 40% of the buyers. So corporations still close on a majority of the transactions, but keep in mind 20 years ago private equity was probably close to zero or very low single digits in terms of the percentage of deals that they buy. Now it's grown to be a very significant part, and I would say in today's environment, private equity buys probably somewhere between 33 and 40%, and that varies, but it demonstrates that they are now a very significant part of the buying equation.
Okay, great, thank you. And the last question we have comes from Mark. He asked, how do you see interest rates affecting the M&A market in the instance that interest rates rise?
Well, we've been talking about the Fed tightening here for quite some time, and the best they could do is, what, 1/4 point so far? So, the Fed's got a real problem because, they're really not seeing inflation, near their goal, and they really, until recently, they really haven't seen wage growth, and they really haven't seen a strong enough, robust growth in employment because there's still so many people on the sidelines. So they're in a tough situation for raising rates. Obviously, banks and other financial institutions that make a living off of higher rates are all clamoring for higher rates, but that's just out of self-interest. But I think that maybe we'll see a few notches up over the next year, quarter here, quarter there. But it's, in the whole scheme of things, a few extra quarter increases over the next 6 to 18 months, I don't think it's really going to have any effect at all. I think that the only way it would have effect is that there is a high correlation between M&A activity and stock market values, and so I think that as interest rates go up, you may see some kind of short-term negative effects to the stock market, which will just increase the volatility in the stock market. But I think that unless the stock market sees a sustained effort by the Fed to continue to increase rates significantly over a long period of time, I think you're just going to see very minor corrections with nice bounce backs. And so it might make the M&A market just a little choppy, but if you take a look at the market over a long period of time, like over a year's time, I think that it's still going to remain, very good. I think the only way it's really going to significantly decrease is if something happens like we saw in 2008, where we have a major financial crisis, we go into a significant recession, and then I think it's going to the M&A market will decrease significantly, and then it'll take maybe another year or two to rebound.
Okay, John, thank you so much. That is the end of our questions. If you do have a question after the webinar, for the webinar attendees, at the end of these slides we will have contact information for both John as well as for Kevin Minton with Chief Executive Boards. If you want to go ahead and advance to the next slide. Just to let you know, we do have a webinar coming up in October, which is to retain and reward top executives. And this particular webinar will be on our website again within the next 2 days. Next slide. And first, I'd like to thank you again, John, for sharing your wealth of knowledge in this market and for being here with us today. We hope that everyone has found this to be helpful, and we invite you to contact John or Chief Executive Boards with any questions. We appreciate your time, appreciate you being here with us, and have a great afternoon.